Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is December 19th, getting oh so close to Christmas. Hopefully you have completed all your Christmas shopping and have wrapped all the presents that go under your tree. Happy holidays to everyone out there. Today we are going to take a look at one out of the consumer discretionary sector, Wolverine. Let's jump right in. Which Wolverine Worldwide actually is the name of the company. If you want to know more about this company, check them out at www.wolverine.com. That's www.wolverine.com. That is their homepage where I pulled this information from. G.A. Krause believed in American opportunity. In 1883, he founded a small leather tannery with a handful of employees. With relentless craftsmanship, their Michigan company produced work boots and gloves famous for comfort and toughness. By 1903, Krause and his sons were producing 300 boots a day in their new factory. That year, their thriving business brought electricity to Rockford, Michigan, which is still our home today. And that is their bread and butter. They are a boots and apparel company, so they not only produce boots, but also some work clothing, work boots. If you're in the industrial sector, industrial boots, some dress boots. I did look at their web page there. Engineered to win. Every day is a battle, and we put everything we've got into helping you fight back. Here's how we design boots to tackle what's next: comfort, purpose-built, endurance, right? So again, that is their bread and butter. Over 135-year-old company here in my backyard. I love Michigan companies, so was excited to take a look at this one. Let's jump into the metrics again, www.wolverine.com. Let's jump into the metrics and see if this one is potentially producing or providing any value right now. Now, the reason we were taking a look at them today, down 2.45%, big drop on the day, even though it was only 23 cents. But big drop nonetheless for the price of the cost per share here. We are talking about Wolverine Worldwide, ticker WWW, out of the consumer discretionary sector. Closed out the day, as I said, $9.15, 52-week range, as low as $7.21, as high as $17.85. They are definitely closer to their 52-week low than their 52-week high. Average volume of 1.1 million. Today's was 816,000. Pretty steady sell-off throughout the day, you can see here. Market cap of 727.722 million, a beta of 1.65. So they are much more volatile than the overall market. You might be able to use that to your advantage if you were interested in this company. Wait for more of a pullback down towards their 52-week low, or even setting a new 52-week low. Now, here's where we start running into some issues. Price to earnings, it's not applicable. They don't have a price to earnings because it's in the negative. Earnings per share is also in the negative. That is not a good sign. Anytime I see negative earnings per share, something's going on with the company. Anytime I see no NA on a price to earnings ratio, something is going on with their earnings. Forward dividend is 40 cents paid out in the year. They are a quarterly payer. Very nice starting dividend yield, I will say that, at 4.26%. Ex-dividend date, December 29th. Looks like they will pay out on February 1st. So you do have some time if you were interested in this company to buy them and collect the next dividend. Don't rush out and buy them now. Let's see if there's any reason to do so, or if there is a reason that they are dropping and continue to drop. And a one-year target estimate, at least according to Yahoo Finance, of $10.75. So at least according to Yahoo Finance, they do see some potential upside appreciation on this one. Now, let's jump into the statistics. We're going to look at dividend yield theory to see if this one is presenting any value. To do that, you click on statistics, you go down to dividends and splits. You look at their 5-year dividend yield, 1.9%, compare it to its current 4.26%, or over here, 4.26% on forward annual dividend yield, same number. And since it is higher, and it is much higher, that speaks to some potential undervaluation. But just because a company might be potentially undervalued because of dividend yield theory doesn't mean you should run out and buy it. Let's see if there are some issues, which we're already seeing with the price to earnings and the EPS here. They do have a low payout ratio, at least according to Yahoo Finance, of 20.51%. So they do have a lot of room, a lot of runway to continue to increase their dividend or pay down debt, reinvest back into the company. Now, let's look at, if you were to jump into financials, you'd find some really good information there. Balance sheet, income statement, debt to equity ratios. Are their margins growing? Are their assets increasing? Are their liabilities decreasing? Are they paying down debt? What is going on with free cash flow? If we are a dividend growth investor, or at least me, I like growing free cash flow over time, because typically if you have growing free cash flow, you have growing dividends. So going back to 2019, you see 188 million in free cash flow. 2020 jump up to 298 million in free cash flow. 2021 huge drop in free cash flow down to 600, that'd be like 690,000, and then a further drop in 2022, negative 215 million. It looks like they're back on track here in 2023, though we're not finished with the year yet. You also see that they are repurchasing some of their own shares. Big repurchase here in 2019. So not only did they have decent free cash flow, they bought back a significant tranche of their own shares. Decreased their buybacks here in 2020, but nice jump up in free cash flow. Increased it a little bit from 2020 in repurchase of shares, but big drop in free cash flow, and that does not really account for the drop in free cash flow. Still buying back 2022 shares, but a huge drop in free cash flow. Overall, if I looked at the repurchase of their stock in 2019 plus where they were at in their free cash flow, I would actually say, based on what they're projecting so far in 2023 to date here, free cash flow is flat, I would say. I would not really call it increasing. Maybe from 2022 to 2023 it's increasing, but not over the last 2 to 3 years, right? So that is a bit concerning to me. The EPS issue, the PE ratio issues. I'm seeing some red flags with this, and I will just say apparel companies right now are having a hard time with everyone jumping into, the Amazons out there, everyone creating their own marketplace online. A lot of people are able to buy and sell boots, coats, the same type of materials that this company produces and sells. They're able to buy those from other countries and sell them on the cheap here online. My wife even has she sells Zaya products. My girls, I have 2 daughters, and my wife liked to wear them, so she signed them up just so she could show them, my daughters, how a business works and a way to buy, cheaper. They get points or dollars whenever they buy something, and then whenever they buy something, it makes it cheaper whenever they're selling goods. So it's a way for my daughters to get exposed to a business, as well as for us to save some money selling some apparel online. So there are a lot of people like us out there online that are selling apparel like this company does. So it's really, really hit the margins for companies like this. So I'm a little concerned when I see the negative numbers and NA numbers right off the bat. That's a big red flag to me. Let's keep going. I always recommend more than one source. So one of them that I like is stockanalysis.com. They have 6 stock analysts that have taken a look at this. They call it a consensus hold. And it's actually right on the edge of a sell, right? Much closer to a sell than it is to a buy. But so far, those 6 analysts, the consensus is a hold. And they see a low estimate of $7. So they actually see it setting a new 52-week low, which would be a 23.46% decrease from where it currently sits. They have an average estimate of $9.67. That would be a 5.74% increase from where it currently sits. And if it happened to hit their high of $11, that would be a 20.28% increase. All the while, you could collect that 4+% dividend yield so long as they maintained the dividend over time. Now, I'd like to get into statistics here. They show you all the same information that Yahoo Finance does, just in a little different manner. So click on statistics. I like to look at return on equity and return on invested capital, like 10% or better for those metrics. And that really tells you how well a company is doing with its capital, reinvesting back into itself, expanding its business, making acquisitions. And these numbers look terrible. Return on equity, negative 92.8%. Return on invested capital, negative 25.45%. That is just not good. They are burning through cash. The cash they are reinvesting back in themselves, you might as well just set it on fire. These numbers are not good, folks. And this one was recommended by a subscriber, so appreciate the recommendation here. But these, so far, I'm not seeing very good numbers on this company. And I really want to like this company because, again, I'm a Michigander. I live in Michigan. I wasn't born here, but I grew up here. I was born in Wisconsin, but lived here most of my life in Michigan. So I really love hometown companies, home state companies, and I really want to support them. And I've owned Wolverine boots in the past, so I'm familiar with their product. But overall, I'm separating the product from the business. Right now, this business looks like it's in trouble or having some issues anyway. They do not have an estimated EPS growth. I like 5% or better, and they do not have a forecasted revenue growth. Again, I'm anticipating or assuming that that's because this company is having some issues, and it shows. Return on equity, like I said, negative. Return on invested capital, negative. Just not good metrics overall. Let's continue. Now, they are a quarterly payer. They do pay out on the February, May, August, November timeframe. Their payout ratio is not listed here. We saw it was around 20% on Yahoo Finance, so I would want to do a little bit deeper dive to make sure that that number was accurate and they are not having. Anytime I see NA on a site, it means that they might be over 100%. So, not sure if Yahoo Finance is correct or if this stockanalysis.com site is correct, but they do not have any dividend growth. I did go back to 2020. They did have growth. They started paying dividend in 2013. They stopped growing their dividend in 2019, so they have not had a dividend increase since 2019. You can see that clearly here. It's been $10 since 2020, December 31st, 2020, and all the way up to date in 2023. So no growth, a lot of negative numbers. Return on invested capital not looking good. Return on equity not looking good. No forecasted EPS. Just overall, in my opinion, I would avoid this company right now. If you are interested in it, I would throw it on your watch list and maybe watch it over the next couple quarters, see if they get things figured out. Again, it's a Michigan company. Really want to like this one, but overall, the numbers just don't look good right now, in my opinion. This is the vested interest stock screener. This is how I set up the videos. It's also how I look at a company on a high level to see if I'm interested in buying. If I am interested, I add it to my watch list and do more of a deep dive into the company and do a discounted cash flow analysis on it to see what I'm willing to pay. And that is really it. Let me know what you think of Wolverine Worldwide down in the comments below. Have you worn their boots? Do you buy their apparel? Are there other ones out there that you like? I mean, this is like a company like Dickies, Carhartt. I mean, this is the type of company that they are. So there's a lot of competition out there for this company. And again, I don't know what really sets it apart from others that I'd be willing to invest in it. And overall, the numbers, at least right now, just do not look that inviting. They actually look a little concerning to me. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us here on this journey to financial freedom. Join the vested interest community. Hit that subscribe button down below. Hit that notification bell so you're notified whenever we post any new content, and share with anyone you think that might find value in the content. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Wolverine Worldwide you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down in the comment section, and I will work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. We'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and claims money. You should never invest any amount you're not comfortable losing. Always do your own research, investment, your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.